September has seen some extreme volatility in financial markets, particularly in the UK. And we're going to look at why markets have reacted the way they have over the past few weeks. The Chancellor's mini budget this month was not well received by financial markets. The long-term cost to the government of funding a surprise higher rate tax cut saw some investors decide to sell sterling and also UK government bonds. This saw the UK currency fall to an all-time low against the dollar and created some short-term dysfunction in both the currency and also the gilt markets. Now, this ultimately led to the Bank of England intervening to buy long-dated gilts to support liability-driven investment funds and also defined benefit pension schemes. Meanwhile, on the economic front, the UK is very likely to head into recession, and arguably the US has actually entered into one. And clearly, higher interest rates will have a direct impact on UK consumers and businesses, and this further exacerbates the existing cost of living crisis. However, one positive is that both UK corporates and consumers have emerged from COVID lockdowns with much healthier balance sheets than pre-pandemic, with a record level of savings balances. Additionally, the labour market is still tight, with unemployment at historically low levels of 3.6%. These help to offset the impact of higher costs of living. So focusing now on growth assets. Financial markets are forward-looking discounting machines, i.e. the impact on corporates and their earnings has been mostly priced in, and UK valuations are attractive compared to history and their peers. What really matters in the medium term is still the actions of the US Federal Reserve and the general global economic backdrop. In terms of growth asset factor performance over the month, unsurprisingly, given the volatility, the quality factor gave one of the best returns, with growth and smaller cap the worst performing. Turning to defensive assets, as we've already covered, it was a very difficult month for UK government bonds. However, a lot of bad news appears to have been baked into pricing, and on valuation grounds, bonds are looking as attractively priced as they have in many years. So in summary, volatility could remain elevated for some time, and there is a lot of noise at the moment in the market. And it is that old adage of time in the markets, not market timing, which is important right now. And for investors, in times like these, staying diversified, invested, and also managing those emotions is key for navigating the current financial landscape.